Hey everyone, this is Rob Keentzer, goldsilverpros.com. It is Thursday, August 20th, 2020, and this is your gold and silver market update for this Thursday. This is going to be a bit of a short report because there's not a whole lot of new information going on in the market that's really worthy of a long analysis. So there's a little bit of shorting in the market. Gold and silver have been brought back down, recovered a little bit today. You can see gold's up 12 and silver's up about 59 cents. So overall, they did pretty well today. They're starting to recover. These sharp downward price movements aren't really a big correction that we talked about the last few weeks that could occur in the market. Definitely not a large retracement, just sort of some volatility that tends to scare people maybe new to the sector. But those of us who've been covering precious metals for quite some time, like I have, we're expecting this to happen, especially seeing gold hit new all-time highs. It's going to tend to have some volatility before it reaches another plateau. So there are definitely reasons for that. And then we've got some interesting information on the illegal trading or the spoofing front. Another bullion bank was caught putting in some trades to adversely affect the market. We'll get into that at the end of the video. It's not the first time it's happened, probably won't be the last. We'll start off with gold here. As we can see, we're trading about 1946, 1950 range. It's kind of bouncing up and down. You can see the shorts came in the last couple of days, have been hammering it down. And again, this is futures trading. It's mostly a paper market. I showed you that in detail on the Tuesday video. If you have not watched the Tuesday video or you're new to the series, go back to the Tuesday, August 18th video where I show a time series of data in which I go over how much paper trading is in the market compared to how much physical trading. And it is a fact, it's not conspiracy theory, that the majority of the futures market trading is just paper and they're settled in cash or positions are rolled on a month-to-month basis. It's not physical trading. And so what happens when we look at a chart like gold and we see this red, meaning the shorts are stronger than the longs, overall there's more shorting, that the price will come down. And we definitely see that in the volume. So the last couple of days, we've seen increasing volume. Of course, this is short volume, and that's why the gold price had to come down. Again, that's what happens. And these are paper trades, because when you're shorting, you're not exchanging gold. Now, if the long stands for delivery against your short, you may have to give up the gold. So that's the way the longs make the shorts pay in the market, is they say, okay, give us the gold. And as long as there's gold to be gotten, those will settle out. In the last few months, especially since the economic situation we've had since March, you've seen a lot more standing for delivery on both the gold and silver markets, and that is happening. That's why we're seeing stronger gold and silver prices. But the shorts can come in and they can pound down the markets with issuing a bunch of short trades on the market. Theoretically, there are position limits to what any one account can issue a short at. But that's not at the bullion bank level. That's at the individual trader level. So each bullion bank may be doing business, or each representative on the marketplace may be doing business for multiple clients. So depending on how many clients you have, how many accounts you have, there's a lot of paper that can be issued. And again, go back and look at that Tuesday, August 18th video. We go into really nice charts to show exactly how much paper is sitting on top of this market. In any case, I don't want to belabor that point. We'll get into, we've gotten into gold. We see that we had the short volume here by the red bars. Now we've had, out of the last 7 or 8 days, about half of them have been red. That's why you see the price come down. You see a little bit of bullish come in here on the gray bars. It came up and then back down. I mean, it's just simple trading volume, nothing to be too scared of. And you see it here. The interesting thing to note is when we're seeing the increases in volume, it's not longs, it's shorts coming in. These increases are shorts, and they're paper shorts offsetting the longs requesting delivery. And that's why we've had a little bit of retracement in gold from about 2050, 2060 down to about 1950, about $100, which, it's not really a big deal. $100 at this point when gold trading around 2000, honestly. Seems like a lot, but in this market in which there's a lot of contention for actual gold and silver, the physical, it doesn't surprise me at all. Let's go ahead and blow this chart out to about 12 years. And we're going to basically look at the range that it's trading in. You can see I've drawn some support and some resistance line across here from previous highs or support lines from the previous bull market. Those are psychological points at which traders will look at and decide, do they want to push through, either go long when they reach a point like that or come back. And two other lines I want to point out that become psychological lines are the 50 and 200-day moving averages. These are the most common moving averages. Now, you can get really complicated and get into any type of moving average you want. You can get into Fibonacci sequences. We're not going to cover that in this video. It's a little complicated for the average market participant. If you're an advanced technical trader, and that's something you may want to learn how to do. We have an upcoming interview with the technical traders that they specialize in doing that technical analysis. So I think that'll be a treat for you guys who really like to get into the charting. Stay tuned over the next few days for that to be released on the channel. But anyway, these lines are the ones we look at, just the general lines we look at to give us sort of the big milestones on the market at which we think we could see some resistance or some support. And maybe the trades will hang around those lines or trade in between those lines. It's called range trading. So we can see here the previous all-time high in gold in 2011 was around $1,900. We shot up through that to 2050. Now we're coming back down and retracing to the support line. It would not surprise me at all if we came back down to 1900. You know, gold's what I call the decision month. It's not until December. And the reason I say that is because of open interest. I'll define open interest for you guys. All it means, the open interest here, and you can see open interest at the top of the chart, is a total amount of longs and shorts on the market, whether it be a paper trade or somebody wanting physical delivery. It's all aggregated into something called open interest. And when you see a massive amount of open interest in a given month, and you can see the lead up sort of like this bell curve, you know, 2,000, 72,000, 400,000, back down to 3317. This is a bell curve. So people are expecting some decision to be made about the gold market in and around December of 2020. I know certainly, you know, October, there's 72,000 open interest. That's not, you know, nothing to shake a stick at either, but really the big decision month's December. So I feel like in December, we're really gonna know where the gold price is going. I think it's partially positioned that way with the upcoming election. I think there are some fears about the economy and deflation given the problems we've had since March and other things. And I think that's why you're seeing all this open interest for December. That is a choice by the traders to pick that month for that reason. There's also some seasonality in the gold price in the fourth quarter of the year due to the jewelry trade in China and India and things. Gold tends to get a boost up until the end of the year. So people may be waiting to see how that affects the gold and silver market as well. So a lot of fundamental factors go into why people chose December of this year. And I think the election is a big one. I think the seasonal trade in gold is a big one. And it's just been a crazy year. So I could see why people are loading up on contracts for the end of the year. They're basically looking back at the year and saying, you know, how did this year affect gold? Where are we going to go in January, February, March of next year? That's what this is showing you on the charts. And that's the decision that's going to be made by the traders in the gold market. So definitely in December, we'll see what happens to gold. It could either retrace. I mean, if the shorts come in and just pound the paper down, making their bets on the market, you could see it retrace maybe down to 1,800, which is a critical support line here, which would be about another $150. It could come down to the 200-day moving average, which actually right now is about $1,800. So I would say if it's going to retrace, if in December, the shorts really come in and pound it down, there aren't enough people going long and taking delivery on the market. Maybe there's a lack of liquidity of gold, or maybe people have just gotten what they want for the year. And we just don't see those longs come in. We could come back and hit 1,800. And you know what? That's not that big of a retracement given this move we've had since 2016. Well, actually 2018. We have a little bit of movement in 2016, but since the fourth quarter of 2018, when they had that 20% stock correction, if you remember, the Fed tightened their easing programs and I think raised interest rates just a tad. And then we had 20% stock correction. And then that's when gold shot up as a safe haven asset. And we've pretty much been going up from there, you know, and we came up all the way from about 1,100. So to come back to 1,800 is not a horrible move. I wouldn't let it affect your long-term view of the gold market, especially with the fundamentals being so strong. But in any case, I mean, that's something to pay attention to there. All right, we're going to transition over to silver. That's enough on gold for now. You can see silver, the exact same thing. And you can see silver, there are more negative days on the charts here in the trading than there were gold. I think gold was something like 4 out of 8 days. This is something like 6 out of 9, 7 out of 10. It's, well, I think it's like 6 out of 10 maybe. There's 4 long gray bars here, and I think 1, 2, 3, 4, 5, yep, 6 negative bars. And so silver's been a little bit more of a battleground. Silver's more volatile. It doesn't surprise me. It has both a monetary component and it has an industrial component. So it's a little bit of a different metal. And you can see on the red days just brings it right back down. An interesting thing, when you see red cloistered around the 10th and the 19th, 20th, you look at the 10th, you see the volume increase, 19th, 20th, volume comes up a little bit. That's shorting. This additional volume is shorting. And I think people are shorting it going into silver's decision month, which is September, because there's a lot of open interest here, total volume and open interest. But look at December. The open interest has started to open up in December for silver as well. So I think September is decision month, but people are loading up for the end of the year as well. What that tells me is there's going to be volatility in silver going to the end of the year. When you have this much open interest now over 2 months on the silver chart instead of one, the longs and shorts can be battling each other. You're going to see big movements in silver back and forth. You're going to see big moves up, bigger tracements, big moves up, bigger tracements, because of the amount of open interest closing the year. And it wouldn't surprise me if some people came in October as well. But I think they saw the gold open interest for December, and they started to pound away at those contracts for December. So silver's really shaping up to be a very interesting story the last quarter of the year. Silver's typically more volatile, and you can see it in the open interest numbers. So just expect bigger, higher moves forward and back, forward and back. Personally, I think there's monetary demand coming into silver. So I think overall it's going to end the year up from where it is right now at about 27 bucks. It wouldn't surprise me to see it at close to 30. Now, if we look at the long-term chart on silver, we can see, let me blow this out to about 12 years. I don't know if it's going to blow past 30 unless the longs come in really hard in both September and December, because 30 is one of those psychological trading points. It's just an even number. And you can see some trading in the past charts around 30, a little bit below and a little bit above 30. The market tended to recede the first time it tried 30 back here in late 2010. And it was a support line here in about the middle of 2011. And it was another support line here leading into the end of 2012. So 30 is a big psychological line on the chart, this red line. So as we get closer to 30, will we punch through at the end of the year? I don't know. 2 big months to look out for now. It was just September. Now it's September and December. We're seeing that interest come in. And the interesting thing is, I think silver will lead gold. If there's a lot of strong interest in silver in September, going back to the open interest on the futures market, we could see silver try that $30 mark here. If a lot of people come in wanting delivery, a lot of longs come in wanting delivery, we could see it try that $30 mark. And that may mean that it's bullish for both gold and silver coming in December. Again, decision month in gold, and now a new decision month forming in silver for December. Very interesting stuff going on here to end the year, excuse me. On Tuesday's video, I basically said that the paper shorting was restraining gold and silver. Obviously, you can see that in the chart. I'll go back to my share screen here. Obviously, you can see that in the chart when the volume increases and you see these pullbacks. We'll go back to the short-term chart. So that was the theme of that video. When the red's here, it pulls down. These are all just paper shorts. Same thing, gold and silver. But it's interesting to note that all of that trading may not be on the up and up. So just yesterday, the CFTC, Commodity Futures Trading Commission, which regulates these markets, ordered the Bank of Nova Scotia to pay a $127.4 million fine for spoofing, false statements, compliance, and supervision violations within the futures market. So I'll read here a little bit. It says the Commodity Futures Trading Commission issued 3 orders filing, selling charges against the Bank of Nova Scotia, a registered swap dealer, resolving 2 separate enforcement actions, spoofing and making false statements well for swap dealer compliance. These record-setting penalties reflect not only our commitment to being tough on those who break the rules, but also tremendous strides the agency has made in data analytics. The first 2 orders require the Bank of Nova Scotia to pay a total of $77.4 million to settle a CFTC enforcement action arising from manipulative and deceptive conduct that spanned more than 8 years and involved thousands of occasions of attempted manipulation and spoofing in gold and silver contracts. Thousands of occasions. So when you come in here and see this massive paper dumping on the market, oh gee, who's doing that? Sometimes the bullion banks will come in and do these massive, many occasions they'll do this massive short selling, and they just got fined for it, $127.4 million. And it's funny to note that originally it was $800,000, but as the CFTC was collecting information about those $800,000 fine and the trades there, they found an additional something like $20 million more to fine them through that testimony. And there's a lot of damning statements in the article that say basically what they did. But just to explain part of it, what spoofing is when somebody goes in and they say, I'm going to issue, usually it's a short contract. Usually it's not long. It can be either short or long, but spoofing fines over the last 10 years have almost always been short, okay, shorting the market. Spoofing involves going into the trade platform, almost issuing a large or putting in the order for a large short position and then pulling it at the last minute. So you're spoofing like you're gonna make a trade, but you pull it out. And that's enough to spook the market down. You don't actually, and we're going another level here into the analysis of the market, you don't actually have to issue a contract here like you see as reflected in this chart. You can spoof it by going up to the very last second and then pulling back. So you know what, I don't want it. Just that act of spoofing over and over time, many thousands of times, can put downward pressure on the price. And you can see that the CFTC caught the Bank of Nova Scotia, one of the oldest bullion banks in precious metals, doing that on the American markets, and they just got fined a whole bunch of money. So it's very, very interesting, very timely as we talk about this past Tuesday and today about the shorters coming in and just issuing a lot of paper, that a lot of this was manipulative practices. Again, this is not the first time a bullion bank has been fined for this. We've seen other major bullion banks get fined for this as well on their trading desk. A lot of times they'll spoof or they'll short to make money on the trades because these trading desks have clients. The clients have data. They know what their trades are. And a lot of times they'll issue these massive trades just to make money off their own clients. But when it's done on a repetitive basis, it holds the prices down, and the CFTC will come in and say, wait a minute, you're adversely affecting the market, not allowing true price discovery, essentially. That's against the exchange rules. Boom, here's a big fine. So that's what happened against Bank of Nova Scotia. Very big news for anybody who did not believe manipulation of the precious metals. Here's front and center for you, undeniable proof that it happens, and that a lot of these short positions are not legitimate in gold and silver. And then a lot of stuff goes on, even prior to submitting these short positions to try to hammer that price down. A lot of goofy stuff going on to bring the price down. And that's why I think both gold and silver are going to continue in their bull markets. There's a lot of goofy stuff going on to try to hold them down, whether it's just making money off an individual trade or somebody saying, we just want cheaper precious metals, maybe so they can buy it off market. Who knows? But at the end of the day, when you have all this goofy stuff going on, trying to hold the prices down, that's bullish for the precious metal, because as the market absorbs, as you say, wait a minute, that means the precious metals are undervalued because of all this goofy paper stuff going on. We need to come in and push it higher. And then longs will come in, and it's like a double whammy effect. Not only you're removing those manipulative short positions, but the longs are coming in and saying, oh yeah, well, you just mispriced this asset. We're going to price it higher. We're going to go long. And not only that, but we know it's cheap, so we want the physical metal. They know now they can go onto the markets and they can look at gold and silver's price, know that it was manipulated down, against exchange rules, so it's undervalued. So they're going to go stand for delivery more on the COMEX, and they're going to try to take that delivery off the COMEX from the shorts. And that's why I think in gold, the December decision month from the open interest, and now silver in both September and December are going to be very interesting. That's why I'm still bullish. And I haven't even gotten to the fundamentals yet. We haven't talked about negative interest rates and stuff like that, which are fundamental arguments for why people want gold and silver. We're just talking about the futures trades in the paper. And I think over the last month, I've demonstrated thoroughly by looking at the data how the market works and how these metals are underpriced. Stay tuned for Sunday where we start talking about fundamentals, and we're going to lead off with negative interest rates. And we're going to talk about how negative interest rates affect people's investment in gold and silver. I think that's going to do it today, guys. That's enough for today. Just wanted to give you your view, ending up the week here, this August 20th. Hope you guys got a lot from it. Stay tuned. We are definitely going to have more for you. Sunday's going to be fun as we start getting to fundamentals, and the next Tuesday will be fun as we go take a look back at this week in the market and look forward to next week as well. Till next time, guys, this is Rob Keynes with goldsilverpros.com.